Well, good morning. It is Friday, October 7th, Financial Friday. My name is Eric Atalano, your loan officer here in San Diego, California. And I wanted to take a quick minute just to share with you PMI, or principal mortgage insurance, and how it affects your monthly payments and what you can do to leverage your benefits with mortgage insurance. So before we go any further, let me introduce you to my website. If you have any questions and want to read any of the blogs that are located on here, you can go to ericatalano.skylinehomeloans.com, and that will also be indicated in the verbiage below the video. Thank you for watching. Let me know if you have any questions. I'm more than happy to help. So let's go ahead and look at the example that I've created and the payment scenarios created for these this principal mortgage insurance. Now, if you're aware of mortgage insurance, it is only applied if you make less than 20% down payment on your purchase, which is fine. You could do that. But in some cases, when you get mortgage insurance, you're either forced to refinance to get out of it, or you really don't know how to get out of it, right? So let me answer how that works. So you'll have, which I don't have an example here of, but FHA is a very popular loan program for those families that need to get into their homes with less than 20% down, and they need an aggressive interest rate, but they also attach a mortgage insurance fee to that. FHA's conditions for that right now is that the mortgage insurance will stick to the life of the loan. So that means that you're forced to refinance out of the mortgage insurance, and that refi could be costly sometimes. Hopefully you do it when you have equity in the home, so you don't have to pay any actual closing costs out of pocket. You can roll it into the actual loan amount and get out of the FHA loan at that point to relieve your mortgage insurance payment and usually save money monthly. But if you're going into this without the FHA loan and you're purchasing a home valued at $420,000 and you're only putting 5% down, which is $21,000 total, I'm going to give you the breakdown in 3 separate scenarios so that you can go ahead and see what's eligible to you and how it applies. So in the first box here, this is just a traditional conventional loan, 30-year fixed with mortgage insurance that you'll be paying monthly. The interest rate today going for that, if you have a credit rating of 680 or better, is going to be at around 3.75%. Now, that no two borrowers are alike, so this is a generalized rate, and I'll be more than happy to help you find out what rate you're eligible for if you want to chat with me. Your monthly payment, and we'll go through the payment breakdown, is about $25.94, taking into consideration your taxes and insurance and your mortgage insurance. So that's going to be $72 less than the other 2 options here. Now, if you wanted lender-paid mortgage insurance, that interest rate goes a little higher. That means that in lender-paid mortgage insurance, you actually introduce your mortgage insurance into the interest rate. Now, why would someone do this? Because your interest rate is actually a tax credit. Consult your CPA about this, but what you'll have is this option to write it off, and it allows you to continue to do that. And your monthly payment really isn't that much different. $24.95 from $25.17 is not that much, and the math should be easy. It's only just a couple bucks away. Okay, so take a look at that option. You can always roll it into the rate. This rate again applies to individual clients. They have different criteria, and this could actually go lower if you put a little bit more money down. If you have like 10% or just between 10 and 5, you can get a little bit more of an attractive rate here usually. And again, interest rates are reflective of your credit rate. So the next option that I wanted to show you is 30-year fixed with a down payment assistance program. You'll see that the interest rate is right in the middle of what the other 2 previously were, but the actual mortgage insurance calculation is less. Okay, let's take a look at all 3 of these combined. So when looking at these all together, you'll see that your actual monthly payment breakdown is a little different. Your mortgage insurance in the first column is $123 here. The mortgage insurance in the third column is nil. There's really none. And the mortgage insurance with down payment assistance is actually lower than all 3. And why is that? Well, down payment assistance doesn't require that you actually have a full coverage of 25%. Mortgage insurance is a percentage coverage of the loan amount. So you get 18% coverage. So you get a little bit less when you get down payment assistance. If you are qualified for the down payment assistance, it's a great program. You let me know. If you want to learn if you're qualified or not, I'll be more than happy to share that with you. But this, again, is just mortgage insurance as a whole. Now, what people tend to forget, too, that is when you go to conventional, and let's go to the first column here, and you have already a pretty good payment and a pretty good rate, The mortgage insurance for this program does not stick to the life of the loan. If your property value reaches the 22% equity or the 78% loan to value in the time frame allowed, you can actually just get an appraisal, find the property value that it meets the requirements, and then you can have it removed. It's that simple. Okay. So this was just a quick snippet of mortgage insurance, and I really hope that this reaches you in good health and spirits. Please feel free to contact me if you do have any questions about any loan programs available, if you're available or eligible for any loan programs in your area, and I'll be more than happy to walk you through the criteria. Have a great weekend and happy home shopping.